Welcome all. Thank you for attending this webinar.
I'm pleased to see that we have a very international audience with people joining from Poland, Turkey, UK, Ireland, Spain, Israel. It almost feels like the Eurovision Song Contest. I would then, by the way, give 0 points to the Netherlands for the tax measures we're going to discuss, as they have a severe impact, a negative impact on our clients and I think also on our practice. It is, by the way, our first webinar, so we are very excited. Excited is not the word I would use for the topics we're going to discuss in this webinar. However, they are very relevant for the international tax practice. A practical comment: if you have any questions, you can use the chat function. And if the questions are easy to answer, we will answer them during the webinar. If they are difficult, we will just ignore them. I am, by the way, joined by my colleague Inakki at almost 1.5 meters. Inakki started almost 2 years ago with HVK Stevens, and I'm slowly turning him into an international tax advisor like me.
Thanks, Joost. Joost van den Berg started almost 4 years ago at HVK Stevens, and he's currently heading the international practice. Before joining HVK, he has lived and worked in Luxembourg for almost 10 years. Yes, there are actually people living in Luxembourg. Joost is also an of-counsel of Lexfield, or Luxembourg partner firm, and his specific expertise is advising mainly private equity funds with combined Dutch-Luxembourg investment structures. So you would not be surprised that later during this webinar, he will tell you that Luxembourg might be a good alternative for the Netherlands in case you are impacted by the new Dutch tax measures that we will discuss during this webinar.
Thanks, Inakki. Inakki's specific expertise is, by the way, preparing webinars. HVK Stevens is a mid-sized tax and legal firm which focuses on private equity, private clients and corporates, often with an international element. We have offices in Amsterdam, Rotterdam, Curaçao and Luxembourg via Lexfield. We have in total approximately 85 people working in the various offices and teams. The focus of this seminar is mainly to discuss the impact of several new tax measures on intergroup royalty, finance and holding structures, which are often used by private equity funds that have a Dutch platform for their worldwide investments. There are also other important new tax measures, which we will discuss briefly at the end of this webinar. Unfortunately, the new rules will probably make the Netherlands less attractive for these type of activities. This is, for example, already demonstrated by the fact that the government is not expecting any additional revenue from, for example, the conditional withholding tax on interest and royalties, as they really see this as a tool to force these structures to leave the Netherlands, for example, to Luxembourg. So what are we going to discuss? First of all, an introduction into the conditional withholding tax on interest and royalties. From 2024, this withholding tax will also apply to dividends. It will enter into force in 2021. However, is already effective now, as we will explain later in the webinar. Furthermore, we will be discussing the amendments to the Dutch substance requirements for intragroup finance and royalty companies. And from 2022, these may also apply to holding companies. Furthermore, we will be discussing the amendments to the Dutch anti-abuse provisions following the famous, or should I better say, notorious Danish withholding tax cases from last year. These anti-abuse provisions are basically the Dutch implementation of the principal purpose test, So very important for the practice. Finally, and last but not least, my personal favorite, as we are dealing with that now in a few situations, the proposed legislation introducing an exit tax in the dividend withholding tax act following the announcement by Unilever to leave the Netherlands to the UK. As I'm sure you know, the Netherlands used to be a very popular jurisdiction for setting up intra-group finance and royalty companies. As you can see here, a typical structure that we have been setting up a lot. The large tax treaty network of the Netherlands allowed investors, for example private equity funds, to reduce local withholding taxes in source states by setting up an intermediate holding company in the Netherlands. Also, the bilateral investment treaties made the Netherlands an interesting jurisdiction for investment structures, especially for investments in developing countries. This, however, might change now, and this is really, I would say, a deviation from Dutch international tax policy until a few years ago. Important to mention is that although the conditional withholding tax on interest and royalties will enter into force on January 1, 2021, there are no transitional provisions. This means that interest and royalties accrued before that date, so already now or even in the past, but paid after that date, so after January 1, 2021, may fall within the scope of the withholding tax already. It is, in our experience, fairly easy to avoid this. For example, by capitalizing the accrued amounts if there is no actual cash to pay it. However, this should then still be done before year end 2020. So if you have a situation like that, you should call your advisor or us. What are the main features of the law? Well, the withholding tax applies to interest and royalty payments to related entities based in low tax jurisdictions, as well as in abusive situations, as we will explain later. The tax rate is 25% on the gross payment. The trigger for the tax is in principle the moment the amounts are paid or settled with the recipient. However, if there is no actual payment during the year, they are ultimately deemed to be paid by the end of the relevant tax year. Important for trust companies who are, I understand, also joining this webinar, managers are personally liable for the withholding tax. Also important, and maybe surprising, is that also paying entities with operational activities in the Netherlands will fall within the scope of the law. So, for example, if Philips is making an interest or royalty payment, which is of course likely that they make it, to a related entity in a low tax jurisdiction, that payment will be subject to the withholding tax, even though Philips is one of the biggest employers in the Netherlands. Furthermore, even if the interest expense would fall within the scope of an interest deduction limitation rule, and it would therefore not be tax deductible, it can still be subject to the conditional withholding tax. You're then basically punished double, because you don't have the benefit of the tax deduction, but you still do suffer the conditional withholding tax on the actual payment. In case a loan which falls in the scope of the conditional withholding tax is interest-free, and that is not at arm's length, the conditional withholding tax will be calculated on the basis of an arm's length interest. Also, the accrual of a zero coupon bond is considered interest for purposes of this law and hence subject to the conditional withholding tax. As mentioned, the conditional withholding tax only applies in case of payments between related entities. So why does it only apply to payments between related entities? First of all, because being related is an indication, of course, that the structure can be artificial. However, also because, and that's a bit more technical, because otherwise the tax would potentially be an infringement of the freedom of capital, the EU freedom of capital, which also applies to third countries. And it would have been much more difficult for the Netherlands to enforce the tax in such a situation. Now, with the condition that it only applies to payments between related entities, it only touches upon the freedom of establishment, which only applies within the EU. And that is also the reason that specific anti-abuse provisions have been introduced to ensure it does not actually infringe the freedom of establishment. To fall within the scope of the law, the receiving entity should have a qualifying interest in the paying entity. So you can see here, we have a Cayman Island company that owns all the shares in the Dutch intermediate holding company. Well, this is a typical situation that would fall within the scope of the law. So the question is, what is a qualifying interest? If you own more than 50% of the voting rights in the Dutch BV, you are in any case deemed to be holding a qualifying interest. However, also with less than 50% of the voting rights, it could still constitute a qualifying interest if you are effectively controlling the paying entity, so the Dutch BV. There are various ways entities can be considered related. Most are, I think, fairly obvious. For example, via a common parent company. Let's focus on one situation in a bit more detail, which is the so-called cooperating group, what you can see on the right side of the slide. If a cooperating group owns both a qualifying interest in the paying entity and the receiving entity, both entities are considered related and payments fall within the scope of the conditional withholding tax. Unfortunately, there is no definition of what constitutes a cooperating group. However, indications that there is a cooperating group are, for example, a coordinated investment strategy and a lock-up for investors, what you typically see in private equity funds. So on this slide, you would see that individually none of the investors would own a qualifying interest, but because they are considered a qualifying group, together they own more than 50% and they are deemed to own a qualifying interest. Then the next question is, of course, what is actually a low tax jurisdiction? As the payment would only fall within the scope of the law if it is made to an entity which resides in a low tax jurisdiction. So what is a low tax jurisdiction? Countries which are on the EU blacklist and countries with a statutory CIT rate of less than 9%. The good news is that the list of countries will in principle be made public every year in a ministerial decree. It's the same list, by the way, that applies for the controlled foreign corporations in the Netherlands. In case the Netherlands has concluded a tax treaty with a low tax jurisdiction, the conditional withholding tax will only apply after 3 years to allow the Netherlands to renegotiate the treaty if needed. The current list, well, it's mentioned on the slide. I think important / relevant countries are the Cayman Islands, British Virgin Islands, Bahama, Jersey, Guernsey. And I do not believe, Inakki, that we have a tax treaty with any of these jurisdictions now.
No, I'm quite sure that that's not the case.
No. So the 3 years period does not apply yet to any of the countries. The conditional withholding tax also applies if the payments are allocated to a permanent establishment located in a low tax jurisdiction, even if the head office itself is not located in a low tax jurisdiction. In such case, however, a tax treaty between the Netherlands and the head office country might prevent the Netherlands from effectuating the conditional withholding tax. The multilateral instrument could obviously change this, though, if there is one applicable to the tax treaty with that particular country. As mentioned, the conditional withholding tax also applies if a payment is indirectly made to an entity in a low tax jurisdiction, for example, via Luxembourg, via the anti-abuse provision. The first condition for the anti-abuse provision to apply is that the recipient is held with the main purpose to avoid the conditional withholding tax. The question to be answered is whether the payment would be subject to withholding tax if the interposed entity would not have been there. Well, as you can see on the right side of the slide, if the Luxembourg company would not have been there, the payment would have been made directly to a low tax jurisdiction and would fall within the scope of the law. So if the answer is affirmative, and furthermore the arrangement is considered to be artificial, the anti-abuse provision is applicable. And the payment will be subject to withholding tax, even though it is not directly made to an entity in a low tax jurisdiction. An arrangement is considered artificial if there is not sufficient substance or activities at the level of the interposed entity. We will later in the presentation discuss this in a bit more detail when we will discuss the amendments to the Dutch anti-abuse provisions in a broader context. Of course, also the question here is whether the Netherlands can effectuate the taxation under an applicable tax treaty. Probably it can with the MLI in place, and thus by applying the principal purpose test. Finally, from January 1, 2024, the conditional withholding tax will also apply to dividends. Effectively, this will most likely mean that the dividend withholding tax on distributions to related entities in low tax jurisdictions will be increased from 15%, which is the current rate, to 25%, as we of course already have a dividend withholding tax applicable in those situations now.
Yeah. Lastly, with regard to the conditional withholding tax, it is important to note that the conditional withholding tax can also apply in case of payments to transparent entities. To illustrate this, we will discuss two situations which seem to fall out of the scope of the conditional withholding tax, but which nevertheless under certain circumstances can fall within the scope. First, if we look at figure 5, we see an ultimate investor that is situated in a high tax jurisdiction country X, and that participates in the Dutch BV through a hybrid entity that is situated in a low tax jurisdiction. At first sight, from a Dutch perspective, the ultimate investor is considered the recipient of the interest and royalty payments, as the hybrid entity is tax transparent for Dutch tax purposes. This would then mean that the payments who fall out of the scope of the conditional withholding tax, as the ultimate investor is not situated in a low tax jurisdiction. However, in country X, the hybrid entity is considered the recipient of the payments. So hence, without further legislation, the payments to the ultimate investor could take place without being subject to the conditional withholding tax. As that is considered undesirable by the Dutch legislator, the legislation contains a provision that stipulates that in such case, the payments fall within the scope of the conditional withholding tax. Another situation we see in figure 6. Here the ultimate investor is situated in a low tax jurisdiction and the hybrid entity in a high tax jurisdiction. And for Dutch tax purposes, the hybrid entity here is considered non-transparent, and as such, the hybrid entity is considered the recipient of the payments for Dutch tax purposes. As the hybrid entity in this situation is not situated in a low tax jurisdiction, the payments to the hybrid entity would, in principle, not fall within the scope of the conditional withholding tax. And accordingly, without further legislation, the payments to the ultimate investor could take place without being subject to the conditional withholding tax, which also in this case is considered undesirable by the Dutch legislator. So also for these situations, the legislation contains a provision according to which the payments fall within the scope of the conditional withholding tax. So these examples show that in case of interest and royalty payments of hybrid entities, it can be very complex to determine whether or not payments are within the scope of the conditional withholding tax. And accordingly, such cases will require a case-by-case analysis.
Yeah, so if you have a situation like that, don't call me, call Inakki. Next topic that we would like to discuss are the amendments to the substance requirements for Dutch financial service companies. Basically, companies that are engaged in an intergroup finance or royalty company activity. This is again, I would say, an attempt by the Dutch government to make the Netherlands less attractive for international tax structuring. As most of you probably know, the Netherlands already has a list of minimum substance requirements to be met by intragroup finance and royalty companies. Non-compliance with these substance requirements may result in an automatic exchange of information with the source state if a tax treaty is being used. They will basically, so the Dutch authorities will in such case basically inform the source state that they do not consider the Dutch company as the beneficial owner of the interest or royalty payment it receives from abroad. Such exchange of information could result in, of course, the source state denying treaty benefits to the Dutch recipient. The current substance requirements, as they apply today, well, you can see them on the slide. Maybe one that we can highlight, which is the condition that the Dutch company should have a bank account in the Netherlands. As some of you may have experienced, it is very difficult these days to open a bank account with a Dutch bank. Therefore, in our view, as long as the bank account, even if it is located abroad, is operated and managed from the Netherlands, we believe that this substance requirement is met. As of January 1, 2021, two substance requirements will be added to the already applicable substance requirements for Dutch intergroup financing and licensing companies. The first one is that the Dutch company should have an office space available for a period of at least 24 months. This office space should not only be rented or owned, but also be used in the Dutch company's operations and should be appropriate for its business activities in the Netherlands. By the way, in Luxembourg, it was at some point possible to rent office space without a window. I hope that is not becoming the practice in the Netherlands. Furthermore, the second substance requirement that will be added is that the Dutch company should have annual salary costs of at least 100,000 euros for activities relating to the financing and or licensing activities of the Dutch company. Regarding these salary costs, please note that it is not explicitly stated that these have to be incurred in the Netherlands, nor that they have to be incurred by an employee of the Dutch company. Therefore, the relevant persons can be employed by, for example, a group company with on-charging of part of the salary costs to the Dutch company. However, again, what I mentioned, they should be incurred for activities which are which have a close link with the finance or royalty activity. Otherwise, they are simply ignored for this test. These substance requirements may, from 2022, also apply to holding companies. The Dutch government has, by the way, also investigated whether they should deny the application of the Dutch participation exemption to companies not meeting these conditions. Luckily, it seems that they have decided not to do so, as well, in such case, I probably should move back to Luxembourg. Switching to the dividend withholding tax now. Inakki will start with giving you a brief introduction into the history of the Dutch dividend withholding tax, just to put the rest of the webinar in context.
Yeah, thanks, Joost. For a long time, Dutch companies and Dutch cooperatives were treated differently for dividend withholding tax purposes. Dividend distributions by Dutch companies have in principle always been subject to withholding tax, while distributions by a cooperative until 2012 were not subject to dividend withholding tax. For this reason, the Dutch cooperative was until 2012 a really popular and widely used vehicle in international investment structures. In 2012, that changed when the Dutch legislator introduced an anti-abuse provision in the Withholding Tax Act, on the basis of which distributions by Dutch cooperatives to passive investors became subject to dividend withholding tax. However, as private equity funds are typically considered active investors, as they are often involved in the management of the underlying investments, they could still make use of the Dutch cooperative, which they also did, which was often confirmed in a tax ruling. This changed in 2018 when the Dutch legislator, after pressure from the European Commission, introduced new legislation according to which dividend distributions by so-called holding cooperatives became subject to dividend withholding tax. Well, what is such a holding cooperative? A holding cooperative is defined as a cooperative which activities for more than 70% consist of holding shares in associated companies or funding related companies. However, real cooperatives, so the cooperatives that are not considered to be holding cooperatives, are still not subject to dividend withholding tax as long as they have enough substance in the Netherlands. At the same moment, back in 2018, the dividend withholding tax exemption was extended to non-EU and EEA situations in case there is a tax treaty in place. Additionally, an anti-abuse provision was added, ensuring that the exemption would not apply in case of abuse. This anti-abuse provision is similar to the anti-abuse provision in regarding the conditional withholding tax as described before by Joost. Applying, that means that this will apply, the subjective test and the objective test will be applied. Lastly, it is noteworthy that in September 2018, as you probably might have heard, the Dutch government proposed to completely abolish the Dutch dividend withholding tax. However, the government ultimately withdrew this proposal, so we still have the Dividend Withholding Tax Act in place in the Netherlands.
Thanks, Inakki. So this is basically how we got to the point we are now. So what we're now going to discuss are the amendments to the Dutch anti-abuse provision, the Dutch principal purpose test. As mentioned before by Inakki, structure is not considered artificial, and hence the anti-abuse provision of both the conditional withholding tax and the dividend withholding tax does not apply if the intermediate holding company has sufficient substance. This was in the past deemed to be the case if the intermediate holding company was meeting the enhanced Dutch minimum substance requirements. So including the office space and the €100,000 of salary costs. However, following the Danish withholding tax cases, meeting these substance requirements is no longer a safe harbor. It now only plays a role in the so-called burden of proof. If you meet these requirements as a taxpayer, the tax inspector has to demonstrate abuse, and the other way around. If you do not meet them as a taxpayer, you can still demonstrate that the structure is not abusive. According to the parliamentary documents, the following elements could be an indication of abuse. And obviously these indications are directly derived from the Danish withholding tax cases. For example, that there is only a minimum amount of equity available at the level of the intermediate holding company, so in this case Luxembourg. An important one is an important indication is the absence of discretion at the level of the directors of the intermediate holding company to enjoy the proceeds of the investment. As you know, often the intermediate holding company immediately passes on the proceeds to its shareholders. It would thus be helpful if proceeds are reinvested by the intermediate holding company. Another indication is that a reorganization has taken place shortly before new tax measures are introduced. For example, the conditional withholding tax, which will enter into force next year, or that only a minimum amount of tax is paid at the level of the intermediate holding company. In the past, we have managed to get some tax rulings confirming the absence of abuse. However, this is unfortunately becoming more and more difficult. Also, because under the new ruling policy in the Netherlands, also the underlying Dutch BV should meet the minimum substance requirements as well to apply for the ruling. And in our experience, we do not see those requirements being met often, especially not in private equity structures where they simply have a platform in the Netherlands without real activities. Then maybe turning to my personal favorite topic, which is the legislative proposal to introduce an exit tax in the Withholding Tax Act. Currently, as you probably know, there is no exit. There's no exit tax in the Dutch Withholding Tax Act. Therefore, if a Dutch company leaves the Netherlands, for example, as a result of a migration abroad, no withholding tax is triggered. Furthermore, also a legal merger is not considered a taxable event for withholding tax purposes, also not domestically. Both of these mechanisms were therefore used as exit tool, with Luxembourg often as the receiving country, whereby the Luxembourg company would then be liquidated later on. which basically allowed for a tax-free exit from Luxembourg. With the multilateral instrument in place, a migration most likely does not work anymore, as the Dutch entity will, due to the incorporation fiction in the Dutch Withholding Tax Act, still be considered a resident of the Netherlands, as it continues to exist. Prior to the MLI, however, the Netherlands could not tax the post-migration distributions, as the right to tax those distributions was typically allocated to the new resident state, for example, Luxembourg. For cross-border mergers, however, as the Dutch BV legally disappears, no tax treaty is needed to prevent future taxation by the Netherlands on distributions. The incorporation fiction cannot be applied, therefore. Therefore, until recently, cross-border mergers were massively used as an exit strategy by especially private equity firms from the Netherlands, and we've done quite a few of them. However, shortly after Unilever announced this summer its intention to move its headquarters to the UK, a left-wing opposition party submitted a proposal to introduce an exit tax in the Withholding Tax Act, basically to punish Unilever or to encourage them to stay in the Netherlands, as the tax bill for Unilever would amount to approximately 11 billion euros. By the way, this morning we understood that there is another case of a medical instruments producer. Apparently, there the shareholders are already provisioning the tax claim resulting from a potential move. And I think there they would expect that they have to pay approximately 250 million euros if the law will be adopted. The scope of the initial proposal was limited to basically only multinationals, so being groups with a turnover of at least 750 million. However, following heavy criticism on the initial draft, as it would, for example, infringe EU law, the proposal was amended such that it now applies basically to all companies. However, with a franchise or exemption for the first 50 million of deemed profit distributions. A very unhelpful element in the proposal is the retroactive effect from September 18, 2020, which was the day the updated proposal was submitted to Parliament. We have therefore already seen quite a few cross-border mergers being put on hold for the time being. Well, what are the most important features of the proposal? It is levied in the form of a deemed dividend distribution. So the Dutch company is basically considered to have distributed all its realized and unrealized profits upon a transfer abroad. The tax is triggered in case of a transfer abroad by way of a merger, division, share exchange, or corporate migration to a qualifying state. Question is, of course, what is a qualifying state? Well, a qualifying state is a state that either provides a step up to market value for withholding tax purposes upon entering, or a state that does not levy a withholding tax comparable to the Dutch dividend withholding tax. Of course, a question that keeps me very busy is whether Luxembourg is a qualifying state. Luxembourg does not provide a step up upon entering, and in principle it has a 15% withholding tax on dividend distributions. So you would say it is not a qualifying state. However, it does not apply a withholding tax on liquidation distributions, and that is also one of the reasons that Luxembourg was often used in this context. Unfortunately, we do not know the answer, but we're certainly not the ones that are going to test it. The revised proposal now also includes a very generic anti-abuse provision covering basically any transaction which is aimed at avoiding the exit tax. The question is, of course, whether the proposal will be adopted by Parliament, because there is still a lot of criticism on the proposal, because it is still an infringement, even though it has been amended. There is probably still an infringement of various international and EU laws. However, we do understand that there seems to be a majority in Parliament for the law. And as there are general elections in March of next year, personally, I believe that if we get, let's say, more left-wing government after those elections, that the proposal will most likely be adopted, also because it is becoming a very politically driven topic now. So how is the tax levied? It is levied from the shareholder, so it is not a Dutch company that is the subject of the tax. However, the Dutch company is the paying agent. The tax is in principle deferred until a distribution is declared by the Dutch BV or the former Dutch BV. The tax will then be settled with the distribution. Furthermore, the tax or tax claim will be attached to the shares, which means that even if the shares are later sold, the tax claim will in principle be transferred to the new shareholder. So what can you do now if the 50 million threshold is not sufficient and you do want to exit the Netherlands? Well, in our view, there is still a possibility, as you can see on the next slide. We have used an example here with a Dutch cooperative, as we still see many co-ops which were set up prior to the introduction of the holding co-op regime and are now suddenly facing a withholding tax exposure upon an exit. The idea here is basically that a dividend distribution, which would be subject to 15% withholding tax if the co-op would distribute, that it is basically converted into a tax-exempt repayment of a loan. So let's assume that the co-op has sold its underlying investment and now has basically only cash on its balance sheet, which would be subject to the 15% withholding tax. The idea is then that the fund will set up a new BV and will sell the co-op to the new BV against debt. This sale is in principle not subject to Dutch tax, unless the non-resident taxation rules apply. However, that is typically not the case in these structures, as they only apply if there would be an individual owning 5% or more in the Dutch company, which you typically do not see in private equity structures, although you have to be a bit careful with carried interest structures, because there you may have a situation that someone falls within the scope of this taxation, but typically it's not an issue. So the sale should be tax exempt. Then the next step would be that you would basically merge the co-op into the new BV, which is a domestic merger, which would not fall within the scope of the proposed exit tax. And then the new BV would simply repay its debt to the shareholder on, in this case, the Cayman Islands. There is, by the way, a case law from the Supreme Court which has ruled that a dividend distribution from the cooperative to the new BV would be subject to withholding tax by applying the dividend stripping doctrine. However, as I already mentioned, as long as you merge the Dutch co-op into the new BV. In our view, this case law should not apply. Although one could maybe argue that this structure is aimed at avoiding the application of the proposed exit tax and thus would trigger the anti-abuse, the generic anti-abuse provision. The purpose of the proposed exit tax is to subject multinationals moving their headquarters abroad to an exit tax. And this purpose is also clearly stated by the party who submitted the law. Therefore, we do not believe that an exit in a private equity investment structure from a Dutch holding company, from let's say a substanceless Dutch holding company, would fall within the scope of this anti-abuse provision. Hence, our message is that even if the law is adopted, that tax-free exits are still possible from the Netherlands for especially private equity funds.
Yes. And finally, we would like to highlight some last points of attention regarding other new legislation that will enter into force from the 1st of January 2021. The first one is a further limitation of the deductibility of liquidation losses and cessation losses. Currently, such losses may be deducted regardless the country of residence of the liquidated subsidiary. From the 1st of January 2021, the deductibility of losses above 5 million euros will be limited to subsidiaries in the EU or EEA countries, and only if the Dutch taxpayer holds a controlling interest in that subsidiary. Furthermore, the liquidation should be completed within 3 years of the start of the liquidation, or within 3 years of the decision to liquidate. Then, as we see under bullet point 2, another amendment will be made to the interest deduction limitation rule in the Dutch Corporate Income Tax Act. This interest deduction limitation rule applies to certain intercompany loans. This amendment will be made to ensure that this deduction limitation rule will no longer result in exemption of currency exchange gains, which currently under certain circumstances can be the case. For that reason, it could be considered to trigger hidden currency exchange gains before year end, to make sure that such gains can still benefit from an exemption. Furthermore, as a consequence of Brexit, fiscal unities for Dutch tax purposes that have a UK top or intermediate holding company will terminate automatically on the 1st of January 2021.
Thanks, Inakki. Lastly, the Dutch government recently announced that it intends to unilaterally amend the application of the arm's length principle with effect from January 1, 2022. The amendment will make a downward adjustment in Dutch taxable profits as a result of the application of the arm's length principle, conditional on a corresponding amount of income being taxed elsewhere in the group. An example of such a downward adjustment under current legislation are, for example, US multinationals that use informal capital structures to move high-value tangibles offshore. The operations then set up in the Netherlands to exploit those intangibles usually justify an arm's length profit that is much smaller than the commercial profits actually realized. The difference is then treated as informal capital and is therefore not taxed in the Netherlands. Another well-known example, especially for the Irish advisors joining, is the downward adjustment for imputations on arm's length interest on interest-free loans provided to a related Dutch entity, whereby the arm's length interest is deductible in the Netherlands, while the received interest is not taxed elsewhere. This was obviously a structure that we have set up many times with Ireland on the receiving end. Although I understand that last year Ireland has changed its rules as well. So what have we discussed today? To give you a quick summary. First of all, the withholding tax on interest and royalties paid directly or indirectly to related entities based in low tax jurisdictions. Although the law only enters into force on January 1 of next year, important is to remember that amounts that are accruing now already may be subject to the tax if paid next year. Furthermore, the introduction of two additional substance requirements, office space and the €100,000 of salary costs for intragroup finance and royalty companies, amendments to the Dutch anti-abuse provisions, such that meeting those substance requirements by intermediate companies no longer serve as a safe harbor. And finally, the proposal to introduce an exit tax in the Dividend Withholding Tax Act. However, as we illustrated, exits in a private equity context are, in our view, still possible. I see that we have not received any questions so far. And we only lost, I think, 2 people during the webinar. So that indicates to me that it was, most of it at least, was clear. Of course, if you have any questions, feel free to reach out to us. The presentation will be distributed and will also be made available later on for replay. So please share it with your colleagues. Well, that was it. We thank you for your attendance, and we hope to see you during our next webinar. I think we enjoyed it, Inakki.
Yeah, definitely.
Yeah.
Thank you for watching.
Thank you.